Hey, what's up, everyone? This is Craig Thomas. Welcome back. Hope everyone is surviving these markets and holding on and sticking to your convictions, whether that's to not sell or to buy more. So, you're the true heroes if you're buying more in this environment. One question I keep seeing people ask is why are interest rates impacting the value of stocks? And in particular, why are interest rates impacting tech stocks more than your regular blue chips, right? Tech stocks seem to be getting hit a lot harder with all this talk of interest rates going up, right? The Fed raising rates. So why is that? Well, today we're going to do a deep dive. I'm going to do an example. I'm going to try to keep it as simple as I can. This is complex material, but I'm going to use Excel to show some side-by-side examples so you can see why it is that tech stocks get hit harder by interest rate increases. All right. Okay, here we have the present value formula, the present value of future cash flows, okay, with respect to your interest rates and time in years. All right. So if someone promises to give me $100 in 1 year, then I would be willing to pay $99.01 if my interest rate is 1%. Okay. Now, if we increase the interest rate, then you'll see the present value of that $100 goes down 2%. Well, because I want a 2% return on my money, so now I'm only willing to pay $98.04. 3%, 4%, 5%. I'm really willing to pay $95.24. That's it, right? So as you can see, as interest rates go up, because that represents your opportunity cost, right? The value of that $100 a year from now goes down. Okay, so let's reset our rates to 1. What if instead of in 1 year, we're going to get that in 10 years? Okay, in 10 years at 1% per year, I'm willing to pay $90.53 for that $100 in 10 years. Okay, if the prevailing interest rates are 1%. Now let's see what happens when we increase the rates. Wow, I only increased it 1%, but my present value is $82. What if I increase it to 5%? $61.39. That $100, by increasing interest rates from 1% to 5%, dropped almost 40% instead of dropping only 5% for 1 year. Okay? So why does this matter? This matters because tech companies and high growth companies are more like getting your $100 in 10 years instead of 1 year. Companies where you get your $100 in 1 year are your blue chips, your Walmarts, Costco, companies like that. Low growth, but very stable cash flows. Okay, so let's look at some examples. This is an example of a stable blue chip stock, right? This is our time in years, 1 year, 2 year, 3 years. Let's say we get $100 in 1 year. That $100 represents our cash flow that this investment is paying us, okay? It's going to grow at 2% per year. All right, that's a relatively low growth rate, approximately population growth, right? So you can see that, it's nothing to write home about. Our cash flows grow every year, but not by much. And we're discounting them at the risk-free rate. These rates I pulled from the Federal Reserve website, okay? Now the 1, the 2, the 3, the 5, the 7, and the 10 are all on the website. The 4, the 6, the 8, and the 9 I kind of approximated. Okay. Now, in real life, if we were discounting cash flows, we wouldn't be using the risk-free rate necessarily. We might be using the weighted average cost of capital or a benchmark rate such as 10% or something like that. But this is just to compare between different types of investments. So again, this is a gross oversimplification. I do want to use real data, but in real life, we wouldn't necessarily discount at these rates. Just want to put that disclaimer out there. Okay. So our total amount of cash flows over here, you can see, is about $1,000.94, right? When we discount it to the present value, it's about $1,000 for all these cash flows. Oh yes, the other thing I'm ignoring is the terminal value. Now, if I put the terminal value there, that would actually increase the impact of interest rate changes. But we're just ignoring terminal value for now. We just want to compare blue chips to tech to growth, etc. Okay. So our base case is $1,000. Now, what is the Federal Reserve talking about? They're talking about potentially 8 interest rate increases of 0.25% each. That's for this year and for next year, right? That's a total of 2%. So let's see what happens when we raise the interest rate 2%, right? And what I want you to pay attention to is this drawdown percentage right here. Okay, 0%. If we do a 1% increase, we're going to lose 5% of the value of this company. If we do a 2% increase, we're going to lose 10% of the value of this company. Okay, 10%, that's a large amount. Okay, now when interest rates go up, what does that mean? What do companies do? Costco, if their costs go up, they're going to pass those costs on to their consumers, right? So that means revenue is probably going to grow higher than 2%, right? But we don't know that yet. That'll be realized in the future. But in the immediate term, when we find out that inflation is going up and interest rates are going to go up, the value of this company loses 10% because a higher return is required in a higher inflationary environment. Okay? So, but let's look at a growth company. Okay? This blue chip, I had it growing at 2% a year. This growth company, this could be like a Google, a Facebook, Meta, Amazon, something like that, right? Where it's profitable today, but it also grows at a high growth rate. Right now, we got to taper that growth rate down. We can't expect to grow 50% every year for infinity, right? But we're definitely growing more than 2%. Okay, so this same starting cash flow, $100 in 1 year, you can see the present value, because of the growth rate, is much higher. I'm paying $3,200 here instead of, approximately $1,000 in the base case over here. Okay, now, but let's see what happens when interest rates go up. 1%, 2%. Again, look at this drawdown right here. Okay, we're losing 12% of the value of this company instead of only 10% for our low growth, stable blue chip. Okay, we're losing 12% here. Higher growth, more of our projected cash flows are in the future, so that's going to lower the present value of that company. Now let's look at a company that's not profitable right now. It's going to be profitable in year 5. Right now, it's losing money. I'm being generous by giving it zero cash flow. But it's going to be profitable in year 5. It's going to grow a lot when it finally becomes profitable. So this high growth company that's not profitable right now, the present value of this is worth more than our blue chip, right? Because of the very high growth that it's going to get in the future. Okay. But what happens when we raise interest rates? 1%, 2%. The value of these future cash flows goes down by 15% instead of 12 for the high growth profitable company and 10 for the low growth profitable company. Now, what if we have a company that it's not going to be profitable for 10 years? Years 1 through 9, we are losing money. In year 10, we're finally making a profit. Okay? The present value of that is very low. Okay? What happens if we increase interest rates? 1%, 2%. Now we're losing 18% of the value of this company instead of 15%. Okay? Now what if some people think interest rates are going up higher than 2% eventually, right? What if we go up to 4%? Okay? This is my rate increase here, 4%. Now our blue chip's losing 19%. Our profitable high growth is losing 22%. Our profitable in 5 years is losing 27%. And our profitable in 10 years, we're losing 32% of our value. Okay? So this is why the tech companies that are not profitable today, but are promising high growth with profitability sometime in the future, are getting hit the hardest. Okay? Because their cash flows that they're promising you are way out into the future. Instead of your blue chips, which are still losing value, still being hit by interest rates being increased, but not being hit as much. Okay? That's the important thing to remember. Everybody's getting hit, but not equally. Okay? Stable cash flows today, even if they grow more slowly, are worth more, or at least they don't decline as much when interest rates go up. So, God forbid interest rates go up to 10%, as some people might think, right? I mean, your blue chips are, 38%. Again, this is a very crude analogy. I'm not saying that blue chips are going to lose 38% of their value. But this is just to compare the blue chips against a company that won't be profitable for a long time. They're going to lose 61%. So this is why it makes sense that tech companies, high growth companies, unprofitable companies that won't be profitable for a long time are getting hit much harder by these interest rate increases. Okay. Now, at the end of the day, I'm not too worried about these interest rate increases. We still don't know if inflation is going to be transitory or not. It probably won't be, a 1 or 2 year thing. It might be a little bit longer than that, but eventually the supply chain issues will be resolved. Eventually, people will come back to the workforce. And ultimately, those costs will be pushed on to consumers. And at the end of the day, this happened in 2018 when interest rates went up a little bit. And it took about 6 months for us to get back to the previous all-time highs. So who knows how long it's going to take for the markets to come back? Could be 1 month, could be 3 months, 6 months, a year. Could be longer, but eventually we're going to come back. So thank you everyone for sitting through this. I hope this was helpful in explaining why interest rate increases impact tech companies and high growth companies more than your low growth, stable blue chip companies. If you have any questions or have any requests for any other types of videos, leave it in the comments below, and I will catch you next time.